Good day, Doctor. My name is Saw Weng Guan, metric number 269724. Now I'd like to present for the topic about auditing of long-term liabilities. As we know that there are many types of long-term liabilities in the financial statement. Therefore, auditors should assure that the amount being shown is free from material misstated that can help to extend for the recognition of interest expense. To avoid material misstatement in the account of long-term liabilities, most of the business entities choose to follow the more efficient ways to conduct substantive testing. Risk assessment for long-term liabilities consists of inherent risk assessment and control risk assessment. For the inherent risk assessment means that the assessment taken by auditor at the primary stage based on the knowledge and judgment about the transaction of industry that will be separate into three types of inherent risk, which is low, medium, or high. The lower transaction will be lower risk and high transaction will involve the high inherent risk. For the control risk assessment is to measure how effective for the process of evaluation for the design and operation of internal control. The purpose of control risk is to prevent and detect material misstatement in the financial statements. During the process of auditing long-term liabilities, auditors should have sufficient understanding for the entity internal control system about the long-term liability to fulfill the substantive strategy. The next part I would like to discuss is about the accession and related control activities. The accession and related control activities will be separated into four types, which are occurrence, completeness, variation, and disclosure. For the occurrence, it is the process of recording the transaction that occur related to the entity on the specific period. The purpose of occurrence accession is to make sure that the item of the long-term liabilities will not be overstated and to avoid double entry. The auditor should make sure all the documents of long-term liability been authorized that approved by the board of directors which delegated to this authority. Throughout this process, auditor will make sure the auditing activity should be under control because auditor will have the authority to assess the validity of transaction easier. The next one is completeness, means that the entity have disclosed all the documents related to the financial item. Therefore, there are no any omissions and understatement of the long-term liabilities. As an example, the client company should provide a subsidiary ledger related to the long-term liabilities that obligated by the entity and the amount should be disclosed correctly to avoid material misstatements. Variation of long-term liabilities means that the estimation for the specific types of liability as the auditor responsible to make sure that the value of long-term liability is accurate with the actual value that can be posted to the ledger to avoid undervalue or overvalue. As an example, notes and bonds are recorded at the net value after calculated amortized discount or premium by using effective interest method. Classification of disclosure means that the auditor needs to audit the item in the disclosure of financial statement and identify the proper exception to manage the potential misstatements. Therefore, auditors should ensure that all the items of long-term liabilities are disclosed properly in the financial statements. Finally, I would like to talk about the last part for auditing long-term liability, which is the substantive procedures. Substantive procedures in auditing means that method of auditor used to assess the financial statement of client company to conclude a confidence evidence to verify those audit assertion of the financial record so that material misstatement can be avoided. As an example, auditor may apply analytical procedure to check on the agreement and balance of the debt or bonds to make sure the amount is accurate with the actual value. That's all for me. Now I would like to pass the continual part to my friend. Thank you.
Good morning, doctor. My name is Chim Ka Seng. My matrix number 270291. So I would like to continue the presentation with auditing dividend. A dividend is a distribution part of company profits to the investor and shareholders of the company as a reward or returns to the shareholders for investing in the company. Usually, there are two types of share capitals, which is ordinary share and preference share. For the preference share, the shareholders will get a fixed percentage of returns, whereas the ordinary shares are depend on the profit earned by the company during that year. If the company earns more income in that year, then they are likely to pay higher returns to the ordinary shareholders. There are several types of dividend payments that can be made to the shareholders, and the most common type of dividend payments are cash dividends. In auditing the dividend of a company, the auditors usually will examine and audit all the transactions related to dividends instead of using sampling. This is because a company will not pay the dividend frequently in a year, and most probably 4 times in a year. The purpose of auditing dividend declared and distributed is to ensure the transactions are not violating the law and regulations in which the company is solvent. Solvent here means the company has the ability of paying back its debts. So we move to the audit procedure. In testing the financial statement assertions, there are some audit procedures to be performed. The first one is completeness assertions. To ensure the cash dividend and dividend payable are recorded, the auditors need to examine any documents or evidence that is used to support the declaration of dividend as well as dividend payment transactions in the cash disbursement journal. The auditors need to review the boards of directors meeting minutes and stay alert on any unrecorded dividend at the end of the year, as well as the restriction on retained earnings. When we are verifying the dividend, it is part of a liability testing. This is because when the board of directors declare the dividend, it will debit the retained earning accounts and credit the dividend payable accounts. Since the dividend payable account is a liability, so it is part of a liability testing. It is important for auditors to be alert with the restriction on retained earnings because it may bar the company from paying out the dividends to its shareholders, as the dividend is paid from the retained earnings. The auditors also need to trace the prior period error, corrections or adjustment with the supporting documents to retained earning accounts. A prior period adjustment needs to be made if there is an error that occurs in the prior period as dividends are paid out from the retained earnings. So the second is assistant assertions. The auditors need to verify all the transactions related to dividends are supported with valid evidence or documents. The auditors can verify the declaration of dividend by reviewing the board of directors meetings and make the inspection for the evidence to ensure the declaration for dividend is authorized. For dividend payment, if the company has recruited an independent dividend disbursing agent, it could help keep track of everything. The auditors can confirm the amount disbursed with the transfer agent and ensure it was same as the amount that is authorized or approved by the board of directors. If the auditors want to recalculate, he can easily calculate the dividends once he has the number of shares. Like a company has 3 million outstanding shares and get paid for 50 cents for every share get, then the dividend will be 1.5 million ringgit. If the company do the dividend payments internally without recruiting any transfer agent, then we will look at the cash disbursement journal and select a sample of recorded dividend payment. For instance, in the cash disbursement journal, you found a 10,000 payment to the payee, and we will see did the payee on the stock on the date of record. If yes, then the record should be no problem. Besides that, the auditors also need to ensure the declared dividend have been recorded in the correct accounting period. For instance, if the declared dividend that should have been recorded in the next period but recorded in the current period instead, it could bring to the issue of assistance. And the most important thing is that any dividends that is not being approved properly should not be recorded. So we move to the third assertions, which is presentation and disclosure. The disclosure of dividend is important to the equity investor who is seeking income or growth potential, as well as the bond investors when considering a company's creditworthiness. This is because they want to understand how the cash generated by the company is allocated and why it is appropriated. Thus, it is important for having a true and fair view of a company financial statement to help them in decision making. To achieve that, the auditors need to ensure the presentation and disclosure of dividend in financial statements are adequate and in compliance with the standard by looking at the client's company financial statement. To find out whether there is any restriction on retained earning, the auditors need to examine the agreement between the client's company and the parties such as clients' banks, bondholders, or any other creditors. If there is a restriction, then we will need to check that does the client companies disclose this information in the notes to financial statement. Details of dividends such as dividend rates, dividend payable, dividend preference, cumulative preference dividend that are not recognized, or any adjustment made to prior period need to be disclosed in the notes to financial statement as well. If there is dividends get declared after reporting period but before the issuance of financial statement, it shall be disclosed in the notes instead of recognizing it as a liability due to it was a non-adjusting event. That's all from me. Thank you.
Thank you for the earlier presenter. My name is Jiu Junyan, matrix number 270761. I will proceed with the auditing of share capital account part of the presentation. The first part is the meaning of share capital. Share capital is the amount invested by a company shareholders for use in the business. After the creation of the company, the shareholders bring in the contribution to cash, which is shown on the balance sheet on the liability side as an equity account. Share capital is also called shareholders' capital, equity capital, contributor capital, or pay-in capital. Share capital is the primary item of interest in the balance sheet. It is further divided into various kinds as common stock and preferred stock. The par value is represented on the balance sheet. The second part is audit assertions for share capital. If the company shows equity on the balance sheet, it asserts that it exists on the balance sheet debt and that related transactions with equity have been made. For example, if equity is issued, then certain cash will be resettled at the other end. The double entry system of bookkeeping keeps books, cash, and equity share capital in check over here. The share capital has certain rights and obligations. For an example, common share capital has right over retained earnings, where preferred share capital has a preference to be paid and dividend before the dividend is paid to equity shareholders. preferred shareholders enjoy priority over equity shareholders. Preferred share capital is further divided into contributing, participating, non-participating, non-contributing, and further sub-classifications. As of the date of reporting, the company management and shareholders are subject to share capital assertions as per applicable auditing and accounting standards. This would include disclosures of the existing rights and obligations of the company and maintenance of the records of share capital. The following are major audit assertions related to share capital. Existence, ensuring that reported capital actually exists on the date of reporting. Completeness, the nature and types of share capital transactions that have been issued should be recorded. Valuation, share capital is recorded in line with applicable accounting standards. Present and disclosure, an appropriate level of information about share capital is disclosed in accordance with applicable accounting standards. The next part is primary risk of share capital. The risks associated with share capital have decreased with the advent of the dividend mechanism of the share issue and other related aspects. Hardly the big public listed companies have share-related issues. However, the risk of error in a presentation in the balance sheet may happen as a result of accounting mistakes. When equity share capital is overstated, it means that the balance sheet is wrong. Hence, primary risk for equity share capital will be misrepresentation in the balance as a result of error and intentional overstatement that does happen in the case of entities other than corporate forms. Valuation, matching those share capital transactions has occurred in life with both meetings. Reconciliation of share capital receipts with escrow account along with payout capital portion, treasury portion, and amount of refund share capital has been issued in lieu of fixed asset or for some other arrangement, ensuring that exchanged assets are properly valued and take professional experts to help if necessary. Auditors shall apply substantive procedures as existence, verification with a certificate of incorporation, articles of association, and memorandum of association, matching the balance with SEC of relevant authority filings. Completeness, verification of authoritative and issued share capital with supporting documents like bylaws, LOA, and others. Reconciliation of share capital balance with SEC and other filings and general ledger prepared by the company. Valuation, matching those share capital transactions has occurred in life with both meetings. Reconciliation of share capital receipts with escrow account along with payout capital portions, treasury portion, and amount of refund share capital has been issued in lieu of fixed asset or for some other arrangement, ensuring that exchanged assets are properly valuator and tax professional experts to help if necessary. Presentation and disclosure. Ensuring the following items are disclosed in the financial statements as classes of share capital rights related to each class of share capital, audited share capital and issued share capital. Share capital with conversion rights of options adjustment required in comprehensive income. In a conclusion, substantive audit procedures for share capital will include summarizing and reviewing all the equity-related transactions, their purpose classifications, reconciliation of the opening balance to the balance as on the reporting date, and further reviewing disclosure for complying in accordance with the applicable financial framework. That's all for my part. Thank you very much.
Hi, good day everyone. I'm Teo Kok Seng, matrix number 26982. I will continue to present the auditing of reserves and retained earnings. Okay, before we start, let us find out what is retained earning. Actually, retained earning is the accumulated net earnings or profit of a firm after dividend payments. In other terms, it also means that profit surplus and represent the reserves money a company holds for investing back into the business to get a better return in the future. Generally, retained earnings influenced by current year profit or loss and dividend announced and paid. If a company getting a profit in that year, so their retained earnings will increase, and when they pay dividend to their shareholders, it will decrease their retained earnings. Okay, next, retained profit also influenced by these three items, which are net income or loss and dividends, prior period adjustment, and changes in retained earnings appropriations. As we mentioned just now, if a company has high net income, the company will also have high retained profit. For prior period adjustment, it is the correction of an error in the financial statements. For instance, if a company found an error in their financial statement for the past periods, so the company has to adjust it back in the retained profit accounts in the current year, so it will affect their retained profits. For changes in retained earnings appropriations, it is a portion of their retained earnings that set aside for a specific purpose. So if the retained earnings appropriations account increase, so their retained profit will decrease. Moving forward is the audit assertions for reserves and retained earnings. It covers three things: completeness, assistance, presentation, and disclose. Completeness assertions for retained earnings must be tested to verify whether all the transactions, such as declared dividends and prior period error corrections, occurring during the year have been properly recorded in the client's accounts. The issue of completeness happens when the declared dividend is supposed to be recorded in the current period, but recorded in the next period. The next one is assistance. In auditing of retained earnings, the auditor has to test the assistant assertions to check whether there are dividends recorded and paid without evidence of declaration from the client's board of directors. Besides, dividends that has not been properly approved before being announced should not be recorded in the accounting books. The issue of assistance happens when the declared dividend is supposed to recorded in the next period but recorded in the current period. The last one is presentation and disclose. The presentation and disclose for retained earnings account is important in auditing of retained earnings because the client's banks, bondholders, or creditors may impose limits on the retained earnings. The client's capacity to pay dividends to its shareholders is generally hampered by such constraints. In this instance, the auditor must thoroughly evaluate the client's agreements with those related parties. If there are any limits, the auditor should ensure that the customers has correctly reported them in the financial statement notes. Okay, next I will talk about the audit procedures of reserve and retained earnings. First, the auditor has to get a schedule from the clients that show how the clients went from the beginning to the current year's ending retained earnings balance. The beginning balance of the retained earnings must be same with the ending balance in the prior year's working paper. It also means that the brought forward amount of the retained earnings must be same as the carried forward amount of retained earnings. The second step is trace the net total income or loss amount. The auditor has to acknowledge the total income or loss in the income statement is the same as the total income or loss in the retained earnings accounts. The third step is verify amount of cash or stock dividends. The auditor has to make sure that the cash or stock dividends declared and the cash or stock dividends paid is the same. The fourth step is confirm the prior period adjustment transactions. The auditor has to ensure that it complies with the requirement of the relevant accounting standards when there are prior period adjustment. And the last step is ensure all disclosure has been made. Auditor has to ensure that the all required disclosure related to retained earnings are made and presented in the footnotes. In conclusions, because retained earnings is a residual account, so auditor typically do not allocate materially or tolerable misstatement to retained earnings. That's all from me, and I will pass the presentations to the next presenter. Thank you.
Salam Bidwana and a very good morning to our lecturer, Dr. Mazra. I'm Lee Kok Chen 271475. Next, I'll be continue this topic presentation on auditing income statements accounts. Income statement is normally viewed as an important source of information by various users of financial statements. Users analyze the income statements to evaluate the profitability of an entity. For example, creditor will look on the profitability to evaluate the ability of an entity to repay its debt. Also, investor will look on the profitability to make their investment decision. The audit of revenue and expense account depends on the work conducted by the auditor on the entity's control system and balance sheets accounts. This means if the entity's control system is considered weak by the auditor, then the work or audit of revenue and expense account will be more than if the entity has a strong control system. There are several considerations during the audit of income statements account. First, the results of testing controls for the various business processes, which is the results of test of controls. Second, the results of the detailed test of balance sheets accounts and the related income statements account, which is the results of test of details. Third, performance of substantive analytical procedures on income statements accounts. Fourth, detailed test of selected income statements accounts. So here are the four considerations that auditor will need to consider during the audit of income statements accounts. In auditing the income statements accounts, auditors will first have to assess the control risk for business processes. Auditors have to consider the income statements accounts that are affected by the revenue and purchasing process to better understand the effect of a reduced control risk assessment on the audit of the revenue and expense accounts. For example, when there's a justifiably reduced control risk assessment for the revenue process, it provides evidence that the accounts like sales and accounts receivable are not materially misstated. Therefore, the auditors has the reliable evidence on the accounts that are included in the income statements. The audit findings related to the purchasing process are particularly relevant since proper controls over that process provide evidence on most of the expense accounts, and same goes to the revenue process. This allows the auditor to do considerably fewer substantive procedures for these income statements accounts. So there are three types of substantive procedures that can be performed by an auditor. The first, direct test of balance sheets accounts. Second, Substantive analytical procedures for income statements accounts, of course. The third one, test of selected accounts balances. Direct test of balance sheets accounts. This means income statements accounts are normally audited during the audit of balance sheets accounts. For example, the accounts like account receivable or allowance for uncollectible accounts that are under the balance sheet accounts are audited. This means the accounts like long-term debt and accrued interest payable that are under income statements accounts will be audited in the same time as well. Second, substantive analytical procedures for income statements accounts. These procedures can be performed extensively by auditors, as this can provide assurance for the revenue and expense accounts. These aggregated analytical procedures on the revenue account is conducted to identify if there is any unusual relationship that may be an indicative of a fraud. For example, auditors can compare the current year's amount for each of the revenue and expense accounts with the prior year's balances to see if there is any deviation from the prior year's trends. Second, auditors can calculate the ratio of expense accounts to the net sales and compare the percentage across years, or perhaps compare the percentage with the industry averages. The purpose of doing substantive analytical procedures is to provide evidence regarding the fairness of income statements accounts that are conducted at a sufficiently disaggregated level. Also, doing this is to provide evidence for specific revenue or expense accounts, such as the interest and depreciation expenses accounts. The third substantive procedures is test of selected accounts balances. This test is performed or conducted to examine some accounts further whenever auditors consider necessary. Auditors will analyze in detail the transactions that are included or occur in each of the accounts and verify the transactions by examining or perhaps vouching the supporting documentation. There are several accounts that are normally examined by auditors. First, accounts that are not directly affected by a business process. Second, accounts that may contain any sensitive information or unusual transactions. The third one, accounts for which detailed information is needed for the tax return or other schedule included with the financial statements. So these are the three types of accounts that are normally examined or require further investigation by auditors. With that, I wrap up our topic presentations on the topic of auditing financing process on the long-term liability, stockholders' equity, and income statements accounts. Thank you.